Welcome to the Alts Report, where we explore the value of alternative investments and the trends shaping today's markets. Today, we are on site at KKR's global headquarters, and I'm pleased to have Alisa Wood, a partner at KKR, join us. Over the past decade, private markets asset under management has more than tripled, currently in the range of 18 to 20 trillion. Now, most of that growth has been fueled by institutional investors, but with recent product innovation and access to alternatives improving, we've already started to see this dynamic shift and greater adoption from individual investors. Alisa, thanks for being with us today. Appreciate you having us at your office. So maybe to start, I mentioned in my opening, we've seen tremendous growth, right, in alternative investments over the past decade. What's been driving that expansion, and where do you think the industry is heading from here?
Sure, and thanks for having me. I think it's actually pretty simple. I think what we've seen is a few different factors, some macro, some asset allocation related, and some just in terms of where capital is appreciating. You know, first and foremost, we've seen the correlation between asset classes fundamentally shift in the last decade. We've also seen a compression and started to see a compression of returns in certain asset classes depending on different vintage years and different cycles. So early adopters into private equity and private investments realized probably 30, 40 years ago that if you put that in an asset allocation, it winds up being as a hedge or an uncorrelated or a less correlated return stream than public equities or fixed income or things of that nature. And I think that is playing true more today than ever. I think the second piece of it is that companies are staying private longer, right? So there are 40% fewer public companies today. If you look at 20, 25 years ago versus today, companies are, back then took probably 4 years to go public. Today, it's probably 3 times that. So if you want to access, that entire remit of different assets in different companies, you can't just invest in the public space. And then the final piece of it is we're seeing the public markets really be driven by a lot of AI and technology. Nothing wrong with that. But if you think about what different firms are investing in the private space, you're actually getting a very different industry, exposure, which, and by the way, exposure at a different size as well, right? When you think about where private investing is typically happening, it really does give that full diversification. So I think that's honestly what we're seeing today.
So let's talk a little bit about product structure, right? So innovation in product structures such as semi-liquid vehicles, right? They've made alternatives more accessible to a broader audience. What do you think has been the most impactful developments? How have they changed the way investors use alternatives?
Sure. I think it's really simple, actually. In 50 years, we've not seen the evolution of closed-end funds, right? The way those pools of capital have been operating has literally been the same. Nothing in financial services has stayed the same in 50 years, right? So this was ripe for innovation and ripe for evolution, but I don't think it's a revolution. I think it's an evolution, right? And when you think about it, all that's happened is the inefficiencies and some of the frictional pain points, depending on the size of the client that you are, have come out of that structure, right? So a closed-end fund, you manage the operational complexity as the end investor. In an open-end fund, in an evergreen fund, the manager actually owns and operates that operational complexity. That's the fundamental difference. So whether it's J-curve mitigation, capital call management, optimizing for a higher velocity of compounding, better diversification, all of that are the benefits of this, I would say, new evolved structure. It's exciting. I think it's actually creating more opportunity for folks who maybe didn't have that stomach for the operational complexity to actually lean in and get that opportunity to get those same type of less correlated returns.
So as we've seen the number of funds grow, right, the money flowing into them continues to grow. What should investors be considering? In your mind, what will allow certain ones to stand the test of time, where maybe others you need to make sure you're paying close attention to?
I think it's really simple, actually. I think to be a good closed-end fund investor, what do you have to be good at? You got to be good at one thing. You got to invest well. And by the way, I don't want to downplay that. That's really hard to do. That's a high bar, but that's all you really have to do. As an open-end or an evergreen structure, that's table stakes. Being a good investor is the basic, thing that gets you in the room. But you then have to be really good at 2 other things. And you've got to be good at managing operational complexity. Liquidity, cash management, hedging, monthly valuations, all of that takes lots of resources that if you're not going to make that investment, you can potentially get really tripped up on. And then the final piece, which I think this is probably the least understood, is do you actually have enough investment flow to feed these vehicles, right? Like you're taking capital in on a monthly basis. It may be linear, it may not be linear. Yep. You've got to manage the ability to have redemptions on, in many cases, quarterly basis. Like it's complicated, yep. right? And so can you manage that complexity, and can you actually feed it in the right way and make sure you're feeding it with the things that will generate the return versus, low-hanging fruit that may be less attractive. That, I think, is what good looks like. Now, I think that we're going to see play out in the next however many years. I think there are a lot of evergreens that have been created over the last few years. I don't think all of them have a right to win. I don't think all of them will be successful. Mm-hmm. And I think it's really going to come down to how do you rank them on those three metrics.
Yep. So, Alisa, let's close with portfolio construction, incorporating alternatives into portfolios. What are the key considerations for implementation? How should investors think about position sizing? How should they think about liquidity management, and really just overall portfolio construction around alternatives?
Sure, I know it's a great point. I think at the end of the day, you got to start out with the understanding of what should good look like if you're investing in privates or private equity. The answer is you should be able to, and this is just basic benchmarking, you should be able to deliver 500 plus basis points. In some cases, top quartiles 500 to 700 basis points above the public markets. Now, the beauty of private equity is in periods of dislocation, it's double to triple that, right? And that's the power of this. Now, how can you do that? You do that because this is all about long-term capital appreciation. This is not about the quick flip, right? And I think that's how you got to think about the liquidity management piece of it. We like to say that if you're not going to hold an evergreen for at least 5 years, you shouldn't invest in it, right? Now, that's different than a closed-end, fund investment that might be 10 or 12 years long. And part of it is you can pull forward the maturity of the portfolio because of that structure and compound at a higher rate. That is really exciting and interesting, but you've got to think about it in terms of long-term capital appreciation. So when you set your allocation to what you want it to be, that's the framework that you've got to think about it in.
No, I think it's a great point, right? Even though these evergreen funds offer liquidity, if you need it, you should still think about it with a much longer time horizon.
Absolutely. I mean, we say this all the time. This is not a mutual fund,
yep.
right? And when you think about the liquidity is there in case you need it, right? The liquidity is there so you can decide when you want to invest and when you want to redeem. Like that's one of the biggest differences in the structure. And by the way, it does give access to a whole different group of investors
sure.
who wouldn't typically have been able to access closed-end structures. And by the way, that's all good, but you've got to have this long-term mindset, right? Because if you don't, I think you're materially going to impair the ability you're going to have to generate those returns.
Great. Alisa, thank you. Appreciate you having us. And thank you to all of you for joining this edition of the Alts Report. To learn more about alternative investments and our platform at Morgan Stanley, please visit ms.com/alts or reach out to your Morgan Stanley financial advisor or private wealth advisor. We look forward to seeing you next time.